November 2021 live option trade alerts. You can take the 7-day trial of the trade alerts at beststockstrategy.com/memberships. That is beststockstrategy.com/memberships. It's only $19. And if for some reason it doesn't exceed your expectations, then you can easily cancel. All right, let's get started. November 1st, we bought Starbucks to close for a small profit, 25% profit in one trading day. PayPal, open up a new trade. New opening trade in PayPal. Oh, it's actually interesting because this trade, the December 3rd, we rolled it down to 165 like a few days ago, actually on Friday. So Amazon, new opening trade, B+, picked up $219. MasterCard, new opening trade, picked up $103. Hit a new high. November 2nd, sold 3 puts on Tesla. S&P up 17. November 3rd, new opening trade on PayPal. So Zillow reported, and now I have an in-the-money position. I believe that that's the first time I have an in-the-money position in about 4 to 5 months. The last one was Airbnb when it fell to about $134 intraday. All right. So what I did for Z was I closed out the 83 because I had some naked puts, and then I bought the at-the-money call. Rather, I bought the at-the-money put, sold an in-the-money put, and then additionally sold some call options that were short-dated to pick up some incremental premium. So on that trade, I picked up around $720. And I also, perhaps most importantly, I mitigated my risk because I bought the long put option at 70 strike. So therefore, even though Zillow fell to like the low 50s, then I made money on the long put insurance. And I'm also short a 95 in the money put option. So therefore, I can participate in the upside. And in this situation, by implementing this structure, this trade structure, really my only risk is the long put option, the premium that I paid on the long put. And I'm also at risk if Zillow does not increase in price, and if it just basically languishes, then I would have to roll the position out in time and also pay more money for the insurance, come like May or something if the stock doesn't move. But at the same time, I'm able to sell short-dated call options and pick up some additional premium. So therefore, my risk of paying for that insurance and buying the 70 put options is significantly mitigated. And over time, I should be able to make money by selling those call options. So basically, I bought the $70 to protect my downside, sold it in the money put to participate in the upside, and then sold short-dated calls to pick up extra premium. In an ideal scenario, Zillow will stabilize and go up slowly, but I have no more downside risk. S&P was up 30. The VIX was down around 6%. I don't think I've ever had a security drop 40% in 3 days. On the positive side, we completely neutralized the risk and also have a decent chance of making money from the trade. On the negative side, I had to extend duration and I could have closed out the entire position for a profit last Friday or even Monday morning. Another positive thing about the structure is that it basically neutralizes the buying power reduction and it significantly increases the amount of buying power. So you don't have any more buying power expansion risk. So if Zillow fell, this is an easy way when you implement the structure to increase your available buying power because you are reducing the risk with that long put option. Z is currently my only losing trade this year. Besides the small position in Z, all our other positions are fine. Hopefully we'll get to close out Baba next week as well. All right. Facebook, closing trade. Originals are here. Sold for 580 and bought back for 196. VIX is below 15, which is worrisome. I mean, at this moment, it's I think December 4th, it's trading around 30. So it doubled in about a month. Small adjustment for Zillow. Zillow is a long-term play now, slow and steady, no downside risk. Since we paid for the 70 puts, the goal is to sell calls, collect premium, and participate in the upside potential. Volatility is up, which is not surprising. I think that after March 2020, 15 for the VIX is equivalent to 13 prior to March 2020. Closing trade on Amazon. Originals are below. Sold for 350 and bought back for 90. Closing trade original is below. Closing trades. Original is below. Sold for 545 and bought back for 133. Closing trade. The original sold for 182 and bought back for 76. Looking at these trades, it's really good that I closed out a lot of these trades during periods of low volatility because right now with the VIX trading at around 30 and actually on Friday, because I'm recording this on December 4th. So considering that on Friday, I think the VIX hit like 35, all of these trades, or at least, I mean, the majority of them, I know that like Facebook, it's not close to expiring in the money, but you know, because you have a very large volatility expansion, I don't believe that these securities you'd even be able to buy back at 55 or 56 cents, even with the time premium that elapsed. So I guess the takeaway is that when you have periods of very low volatility, when the VIX is trading at about 15, it's imperative for you to close out your winning trades early. Original is close to around a 55% profit. No more Facebook position. All right. S&P up almost 20. VIX and VVIX were also up. Volatility is acting strangely, so we'll be less aggressive in opening new trades until it starts behaving normally again. This is one reason I closed out so many of the Amazon and Facebook trades today. Tesla, new opening trade, B plus grade. S&P up 17, VIX up 7%. Second time this week, the volatility increased when the market increased as well. The divergence in volatility behavior is a red flag. It means the volatility is overextended to the downside. November 8th, new opening trades in Tesla. All right. Dollar General, new opening trade, B plus grade. So I had a 215 strike that expires this Friday for Tesla. Dollar General, bought back Tesla, 50% gain in 1.5 hours. Close out the other one, 50% profit in a few hours. VIX is up 13%. Closing trade for MasterCard. Close for about a 70% profit. S&P up 4, VIX up 11.5%. Amazon down 30. Tesla down 60. PayPal reported earnings and is up around $2. November 9th, sold 5 contracts on PayPal. I said that was an A- grade, but it was actually a bad trade. And just the actual move in PayPal was significantly more than the expected move. I think PayPal's 52-week high is 310, and PayPal is currently trading at about 183, 184. So yeah, I mean, the expected move in PayPal wasn't even close to what the actual move was. Bought back Tesla, held for one day and realized a 60% profit. The reason I'm waiting on PayPal is that there's $1.80 of extrinsic premium and it expires on Friday, so I prefer to wait until the extrinsic decreases to get a better roll. Then I provided my thoughts as a courtesy if people sold the spread option. So here what I would have done was buying at the money put and then sold an in the money put and then extended the duration, and then I sell some short dated calls against it. Then I would sell short dated calls. And this structure also protects you from any additional downside. Amazon closing trade. Original is below. Closed for a 50% profit. S&P down 16, volatility mixed. VIX up 3%. Volatility was significantly off its highs. Amazon up 2.5%. Tesla down again. PayPal down 10.5%. November 10th. Alibaba was up, although it has a tendency to fade as the day progresses. Tesla, new opening position. Or no, that's a position that we currently have. The position expires this week. If you need buying power, then you can close it out since it's showing a large gain. Closing trade. Bought it back for $1.15, sold for $2.75. I only closed one. 60% profit. PayPal. Rolled down the 215 by $2.50. The extrinsic premium was getting low, so I rolled it out. My gut feeling is that PayPal will continue to stabilize. Amazon, starter position for Amazon, just one contract, B plus grade. Close out the other two positions for Tesla. S&P down 38. Volatility up 5%. November 11th, Disney is a decent opportunity. Visa, new opening trade, B plus grade. PayPal, I rolled down the position, financed it by selling some puts. S&P up about 2. November 12th, decent opening. Closing trade on Dollar General. Closing trade on Visa. Original is below. Kept 55% of the premium. Opening trade on Tesla. B plus grade. S&P up over 33. November 15th. Closing trade for MasterCard. Original is below. Closed for a 60% profit. Closing trade for Visa. Closed for a 60% profit. New opening trade on Tesla. B grade, decent but not great. It'd have been a B plus grade if I gotten over 90 cents for it. Our Alibaba position is profitable. November 16th, new opening trade in Goldman. Closing trade on Tesla. We're up on Baba and PayPal. I should have really taken that as a notice to roll and close out some of the existing PayPal positions. I know I closed out Alibaba, but I really should have closed out PayPal. I guess I just thought that PayPal was oversold and that it was going to stabilize, and it just kept selling off. At this time, I think it hit a high of around like 216 intraday. I don't know if it was during this time, but I know that it rebounded from like the low 200s, and then at one time I think it closed at about like 215.80 if I recall. And then I think intraday it actually exceeded like 216 or potentially even got up to around 217 in the middle of November. But I'm pretty sure it closed at about 215.80 if I'm recalling correctly. But the point is that, I was smart in that I closed out Alibaba for a profit, but PayPal, I just felt like, I think its 52-week high is like 310, and it was trading there at about 5 or 6 weeks ago, or around like 2 months ago. And the fact that it fell all the way down to like 200, I thought that it was a good opportunity to sell some premium, and I just didn't roll the positions. But look, hindsight is always 2020. And if I could have done it over again, then I definitely would have taken advantage of PayPal going up, and I would have rolled the positions, sold some call options, and then consolidated some of the positions and, close out some others. Goldman. All right, so here's where I bought back Alibaba. Closing trade. So basically I waited like 45 minutes. This was incredibly smart that I closed out the trade on Alibaba. Closing trade overall after a ton of rolls. I made about $200. Was it worth it? Definitely not. But it was also a good exercise in rolling managing positions. At the moment, the only losing trade I have this year is Zillow. It'll probably take 4 months to get that back to profitable. Although on Friday, in December, I think like December 3rd, Zillow was up around 10%. So, it was up around $6. So maybe it'll be less than 4 months, but it'll probably take around 4 months to get profitable on Zillow again. My current structure on Z has no downside risk, so I'll sell premium to recapture the premium I paid on the long put. Did I learn anything from the Baba trade? Perhaps not to trade Chinese companies. I'm not sure. At the time when I opened the trade, there were very few good opportunities available. Regarding having to flip the 68 calls to the 145 puts, I felt comfortable with the 168 calls, and the stock simply moved way outside its expected range. Overall, the trade wasn't worth the headache, even though we made some money on it. Yeah, so from my memory, basically Alibaba, it was trading, it was kind of like stuck in a range from about like 145 to around like, 160 on the high end. And then I think it went all the way up to like 182 intraday, if I recall. And at that time, I was actually short a 168 call option. So prior to it actually going up, all the way to like 180, which would have left it like close to $15 in the money on the call side, I decided that I wanted to sell some put options, and then close out and use that premium to actually close out the 168 call. So, I closed out the calls and financed it by selling the puts. And then I closed out the entire position by buying back the four December 17th, 145 put options for $1.77. And obviously, that was an amazing trade, because right now, on December 4th, I would probably estimate that those contracts are selling for, I don't know, like $35. Probably a lot of money, probably more than that, like probably 37 or $38. I think Alibaba is trading at about like 110 right now. So yeah, that was a good trade. All right, MasterCard, bought that back. Closing trade top. Buying that back was also a good trade. Close for a 70% profit. Bought this back, close for a 50% profit. It was really smart that I closed out a lot of trades in November. All right, Visa, B plus grade. PayPal's down 5% after having a good week. That's unfortunate, because I was hoping that the 212.5 and 210 puts would expire next week without any modifications. They still might. We'll likely make 1 to 2 trades later today. I'm hoping that the volatility increases so that we can collect more premium. Dollar General, new opening trade, B plus grade. S&P down 12, VIX up 4.5%. November 18th. So here I ended up rolling PayPal down by $2.50 and financed it by selling 175 puts. That was a bad trade. But again, I felt that PayPal was oversold. If I knew then what I know now, obviously I would have sold call options instead of increasing the size of the puts and selling more puts. Even so, the 175 has, knock on wood, because I still have that position and I haven't touched it, but it hasn't become in the money. And also, the closer that it gets to expiration, the more extrinsic premium falls off it. So even if as long as time passes, and even if I have to roll it the day of expiration, then I should be able to roll it down by about $15 or $20. But nobody knows what the future is going to hold. Looking back on it, that was a bad trade. Is it a trade that I would make again? Yeah, it is. It's not, I felt that PayPal was vastly oversold, and basically sometimes the stock just beats you. Sometimes the actual move is more than the expected move. So I don't think that was a bad trade, especially because I had the expectation that PayPal was going to increase in price, which is why I didn't want to sell call options. Generally speaking, when a stock is oversold, it has a tendency to have like a V-shaped bottom where it bounces very strongly off its low and then it rebounds up relatively rapidly. So I was expecting PayPal to increase back up to around the 240 level, and it didn't do that. Two new opening trades. Okay, so this was actually a really good trade that I made. Really good trade. So I think at this time, if I recall, um, at around 10 a.m. on November 19th, I think PayPal at this time was trading at about 199. So it had fallen below 200. And then that kind of indicated to me that there was potentially some more downside risk, and that my previous thought about PayPal going up and challenging like 240 was incorrect, and so that's why. So in this situation, I extended the duration by a month, and perhaps most importantly, I decreased the size from 5 to 4, so I was able to decrease the size by 20%, and I also reduced the strike price on two of the contracts from 212 and a half down to 210. If I was smart, if I could do this over, then what I would have done is I would have sold 4 calls with an expiration of December 31st and a call option price of probably around like 230 or 235. That probably would have given me a substantial amount of premium, maybe about, I don't know, like $2, like 230, 250 per contract, in which case I probably could have allocated that premium to closing out one of the 4 puts, and wouldn't have been able to, instead of selling 4, I would have been able to sell 3 and still gotten a credit by adding on the call component to that. So roll 5 contracts to 4 and reduce the strike to 210. Once PayPal stabilizes, I may roll the expiration in or roll the strike down. We'll see what's best at that specific time. So I reduced the number of contracts by 20% and also picked up an incremental $500 of strike price improvement, while also picking up a credit. S&P down 6.5. PayPal has moved far outside its expected move. These type of moves usually occur 3 times a year. I'm confident that we'll profit from our PayPal position. If it continues to go down, then we'll make some aggressive adjustments. This is why when trading options, it's always important to trade small and think of the worst case scenario. If we're wrong, will we be able to manage the position without incurring significant stress and without panicking? If the answer is no, then you're trading too large. There are a few things we can do, including utilizing the structure that we use for Z and also rolling managing the position. We'll see how things go early next week. My gut feeling is that PayPal is significantly oversold and will bounce back, but I'm also prepared for it to keep falling. We can easily manage the scenario if it happens. All our other positions except Z, which we're waiting to stabilize but have the long 70 put as insurance, are fine, and the other positions should continue to show profit. So here you can see that I'm starting to doubt whether PayPal is going to continue to increase, or rather, whether PayPal is going to bounce back like I initially thought. Okay, this video is getting long. It's 32 minutes. Usually my half-hour videos are about 30 minutes. So I open a new trade in MasterCard, A- grade. Oh, actually, I didn't make that trade. That was a saved trade. So this is the A- trade. I would make this, but I want to be conservative and not be heavily concentrated in payment processors, credit cards. So that was just a trade that I was thinking about. But if you happen to not have a PayPal position that's challenged in this trade, or selling puts on MasterCard is one of the best trades available. Again, I'm not giving financial advice. I'm just saying that, if I didn't have PayPal, then that would be the trade that I would make, or selling puts in MasterCard. S&P down 15, VIX up 7%. The S&P sold off into the close as it fell almost 50 points over the last hour of the day. November 23rd, VIX is around 20. I think I meant S&P is up around 20. S&P sold off 50 points during the last hour of the trading day yesterday, and now VIX is over 20. Oh, no trades that day. S&P up almost 8. So in the morning, I said I'd like to be more prudent, careful, and intentional with new opening trades right now until PayPal stabilizes. November 24th, S&P is down a lot. VIX is up 6.5%. Tesla is down around 3.5%. PayPal is down slightly. Zillow is also up. Small opening trade in Tesla, B+ grade. So here what I did was I felt that Zillow was stabilizing. So I sold the insurance and I bought back one of the Zillow in the money puts. So then now I just basically have 2 short in the money puts with a May 20th expiration and a strike of 95. And with that position with only 2 contracts, I can just sell some calls and puts around it. And even though the calls and puts that I sell will be very far out of the money, I should, with time, be relatively, it should, I don't want to say it'll be relatively easy. So I misspoke. But because it's only 2 contracts, I should be able to make money on that position over the next few months. I sold the protection, the long put option, because the long put option served its purpose. We made money on it both directionally and via volatility expansion. Zillow is trading around 30% of its 52-week high. So now I have 2 long dated in the money 95 short puts, and my belief is I should be able to sell additional premium around that position and get rid of it in 3 to 4 months for a profit. I'll likely end up rolling down the 95 strike, rolling in the May expiration, selling puts and calls. I'll be conservative when selling additional premium on Zillow because my primary goal is to get rid of the position. But this is also why it's so important to trade small. If I had significantly more contracts, then I'd probably be less likely to sell the long puts. So what I'm saying is that I was able to sell the 70 long put as insurance because I traded it very small. So being left with 2 in the money short 95 put options, it's really not a big deal. But let's say I sold like 20 of them, then it would be a much bigger deal. And then I wouldn't have been able to sell the 70 puts because I would need that protection. And to be honest, I think I sold the 70 long puts a little bit too early. I probably should have waited like 4 or 5 days and I could have made like a little extra money, but it's okay. It's really hard to time the market. PayPal. So here's a position I was considering, but I didn't make it. Adobe, new opening trade, B+ grade. Goldman, new opening trade, B+ grade. S&P up almost 11. Volatility down 4%. The market's closed tomorrow for Thanksgiving, November 26th, new opening trade. Oh, so this is Friday when it fell like over 100 points. So MasterCard, new opening trade, B+ grade. The market closes today at 1 p.m. PayPal is up, although it's significantly off its highs. I rolled down Goldman, rolled it down by $15, and rolled it out by 2 weeks. In hindsight, I probably should not have done that because during periods of very high volatility and rapid volatility expansion, you don't necessarily want to add duration to your existing trades because the extrinsic premium that is attached to those longer dated options it's so incredibly high that so in general during periods of rapidly expanding volatility, I think it's almost better to roll your positions in and sell some call options to roll them in because once the extrinsic premium falls off those positions, it's incredibly easy to roll those positions because you're rolling into higher volatility and you're gaining the extrinsic premium. But if you roll out the durations like I did in this position to December 31st, then that December 31st contract now currently has a ton of extrinsic premium on it. Whereas if I waited until like December 16th or December 17th in order to roll the original position, then I would basically be rolling it with virtually zero extrinsic premium. So yeah. But was it a mistake? Probably not, but I probably should not have done that. VIX is very high right now. The issue is I want to be prudent and ensure that we aren't too aggressive. Adobe is up, and we may be wondering why that trade isn't showing a large profit despite Adobe being up $13. And the answer is a large increase in volatility. All right, so over the next 2.5 hours, the market then proceeded to crash. S&P down 107. VIX spiked up 54% in one day. VVIX up 35%. Amazon down 2%. PayPal and Zillow were relatively stable, and VIX closed and Visa closed well off its lows. Additionally, selling calls on Amazon is worthwhile. This is another reason why it's best to not trade too large during periods of low VIX. Just due to the volatility expansion, option prices are significantly higher than they were just a few days ago. With higher volatility, you have more flexibility because you collect a lot more money when selling options when compared to selling options during periods of low volatility. All right, November 29th, decent opening, market is up. Volatility is down. Wanted to observe. Closing trade for PayPal. Closed for 50% of the original premium received. So PayPal, these are those two trades are like A- grades. I'm not opening new trades in PayPal because I may need to sell the December 31st or January 7th 155 strike as part of a roll. The roll will improve an existing position. S&P up 60, VIX down 20%, VVIX down 12%. I'm looking to close out Adobe this week. Well, I didn't have the opportunity to do that because volatility spiked. November 30th, new opening trade in MasterCard, A- grade. S&P is down 35. I want to be very careful opening new positions, but I figure that even if that position gets challenged, I can roll it down another 15%. Last night, the futures market was down 60, so there was a lot of volatility. That's why I mentioned yesterday not put too much emphasis on yesterday's large up move. On the positive side, PayPal is rebounding, was up this morning. New opening trade in Facebook. Sold some calls in Apple. Volatility is very high, so you don't have to be as precise with your strike selection since the available premium is about 65% more than it was last week. I'll send the daily recap in about 30 minutes. S&P down 88, VIX up 18%. Tesla up slightly, Facebook down, Apple down, PayPal down, MasterCard down. 2 major distribution days in the last 3 days. The sell-off hasn't hurt us. The increase in volatility helps us, and as long as PayPal remains stable around 185, then we can easily manage the position. C also seems to have stabilized around 55. One change I'll make until things stabilize is I'm going to stop trading at the market open unless I have to roll, manage a position, or sell calls. So in general, I'll do my best to execute trades during the last 30 minutes of the trading day until the market stabilizes. One exception to this is selling calls. I may sell calls once the market opens, but for selling puts, I'm going to try to wait until later in the day. All right, so that's all for November. And if you have any questions, leave a comment below. You can visit beststockstrategy.com/memberships and enroll in the 7-day trial. It's only $19. And please like this video as well. And I appreciate your attention.